Welcome back. My name's Michael Anthony, and on this channel, we empower badass achievers like you to crush their financial goals and experience true wealth and freedom. Reminiscing about the early days of my investment journey.
Don't let me leave, Murph!
Brings up a mix of cringe and nostalgia. Just keeping it real. So unlike Cooper, I'm not able to go back in time to yell at my former self for making all the dumbass mistakes I did. But what if I had the opportunity? Well, here are the 9 things I won't repeat. Sure, they might be mistakes, but if you're just starting out investing, then you definitely need to avoid these 9 mistakes. Number 1, there was a time when I confused gambling and investing. Back in 2008, I got caught up in this whole investing thing. Cocky as a mofo, I thought I would be the next Warren Buffett. Well, Circuit City Electronics had a stock that took a nosedive, and I thought, hey, it can't go to zero, right? So without doing any real research, and let's be clear, I didn't do any research beyond asking if I thought people would buy TVs, okay? Armed with a shitload of hubris that would make baby Billy proud, I put a good chunk of money into it. Well, that stock ended up being practically worthless, and Circuit City went belly up. It was like walking into a roulette table, throwing down a ton of cash on Black 38 and letting that baby spin. Well, spoiler alert, I didn't become the next Warren Buffett. In fact, I couldn't even afford a buffet after that blunder. Like, for real, couldn't afford it. I learned a big lesson. Trusting my gut without proper research is like playing roulette with my money. Investing isn't about luck, it's about being smart. The Circuit City disaster made me realize this. Now, I see investing more like personal growth. It's a continuous journey of getting better. It's not about quick bets, it's about making thoughtful, intentional decisions. That way, my money doesn't end up disappearing like Circuit City did. So number 2, FUD. This also happened in 2008. When I was faced with a choice about what to do with the chunk of cash from a 401k after I changed jobs. Now, instead of diving right into investing it, I let fear call the shots. I didn't jump into the market because growing up in the 90s, my family had this like fear-driven narrative that the US economy was on the verge of a catastrophic crash. It wasn't based on any research, just fear that the Great Depression would look like a walk in the park compared to what was coming. So surprisingly, my timing was right for a crash, okay? But it was a lot more luck than skill. And instead of investing in the stock market before the crash, I held on to the money because I didn't want to lose it all. And guess what? When it did crash, I clung on to the cash, fearing that a financial catastrophe was on the horizon. It wasn't until the market had bounced back and was even higher than originally that I finally found the courage and put my money into the market. And by then, I'd missed a golden opportunity. If I had put that money in when I thought about it when it was at the bottom, I would have looking at like a 200% gain or something. Talk about an expensive lesson learned. Trying to time the market based on fear, uncertainty, doubt, FUD. It's a risky game. Fear kept me on the sidelines, missing out on potential gains. The pain of that lesson is still with me. Now I understand that money is made by taking calculated risks. And I now dive in even when I'm scared. I ignore the FUD and not attempting to play the market timing game. It's become a crucial part of my investment strategy. Investing as an entrepreneur versus an employee. Another point I got to understand later was the difference between investing as an employee and as an entrepreneur. Years ago, as I embarked on building my insurance business, the monthly metrics reflected success. Growth, check. Increased cash flow, check. The ability to invest more in my business, check. However, even with all these achievements, I felt shame because I wasn't following the conventional wisdom of investing in retirement as ingrained from childhood in the US. See, one day, a crucial question changed my perspective. If I were an early investor in Apple, would I want Steve Jobs to take the money I invested in Apple and go and reinvest it in other companies? Or Should he reinvest it in Apple? The answer was clear. Reinvest, right? What would you have him do? Why was I beating myself up for doing the exact same thing? This realization led me to study the super rich, Jobs, Gates, Bezos, others who had amassed huge amounts of wealth. What I discovered was a common thread. Their wealth wasn't built through a 401k investment or super early diversification. Instead, they were laser focused on making their primary business thrive, investing everything they had into it. Only after achieving mind-blowing success with that business did they start to diversify. Entrepreneurs, I believe, don't aspire to lead a normal life. You're craving freedom to live life on your own terms. So this has been my goal from day one. Those who achieve this level of freedom, we play by a different set of rules. We prioritize making one thing as big as possible before diversifying. Once I embraced this philosophy and shed the employee mindset, not only did my peace of mind expand, but so did my net worth. The lesson learned is that the path to financial success often involves a laser-focused commitment to building and expanding your primary venture before contemplating diversification, okay? Make the business you got big, then be concerned about playing in other fields. It's about playing the long game and prioritizing the growth of your core business so that you can achieve meaningful impact and financial freedom, living the dream you desire. Recently, I had an eye-opening realization about my unique investing style that brought a sense of peace and clarity that I'd been seeking for years. See, I'm not your traditional investor. I spot patterns and trends way earlier than most people, and that's a double-edged sword. Being ahead of the curve has led me to investments like in cannabis, which turned out to be completely premature. Okay? But it also worked wonders for me in the world of crypto and a few others I'm in today. Coming from very humble beginnings and embracing the hustle, I'm a bootstrapper at heart. I could retire today at a financial level above most, and that's partly because I'm not afraid of setbacks. See, even if I quote unquote lose in some investments, I believe in my ability to learn, to grow, to earn more, and keep moving forward. Despite my success, I often feel like a misfit in the world of traditional investing. The whole diversify in stocks and bonds routine, it felt like a square peg in a round hole for me. The nagging thoughts of being a failure because I didn't align with the investment gurus like Buffett and Ramsey, it kept haunting me. It wasn't until I attended a wealth mastery event in Fiji and I listened to private fund manager Michael Smorch that things clicked. He spoke about being a contrarian investor and shared a story of a family who paid a huge tax to invest in Peru, only to see something like, say, 8,000% return years later. His words resonated with me deeply. It dawned on me that just because others might not see the potential I do, doesn't mean any of us are wrong. I don't need to conform to the traditional stock market route if it doesn't align with me. It's perfectly fine because in my world, crypto markets actually make more sense and I understand them fundamentally better than the stock market, as crazy as that sounds. And so in that moment of embracing my unique investing style, I found peace within myself. Suddenly the hesitation around investing capital disappeared and I gained clarity and confidence on how to proceed. The lesson learned: own your investment style, even if it's unconventional. That's a key to finding harmony in your financial journey. It's about recognizing that success can be achieved through many different paths. And what matters most is understanding you and embracing your individual approach to investing. I also found that blindly following investment advice without understanding the fundamentals is a dumb path that will lead to significant pain. Let's break down why. First off, taking generalized advice without personal research means you're adopting strategies that may not align with your financial situation, goals, or risk tolerance. It's like wearing someone else's shoes, uncomfortable and ill-fitting. This lack of personalization can negatively impact the success of your investment portfolio, i.e., you're gonna lose money. Secondly, Not grasping investment fundamentals opens the door to potential misinformation and misleading advice. You're going to do whatever the news says without the ability to critically evaluate recommendations. You might fall victim to biased guidance or market hype. It's like navigating a maze blindfolded, a recipe for bloody noses and shitty decisions. Overlooking risks, exposing yourself to unexpected losses, letting your emotions pull you all around. Lastly, blindly following advice, it slows the development of crucial decision-making skills and it limits your adaptability to changing market conditions. When we don't actively engage with the fundamentals, you miss out on juicy learning opportunities, hindering your growth and understanding of so many different investment vehicles, market dynamics, financial strategies. It's like driving a car without understanding how it works. At best, it's a dangerous choice. So dependency on outside advice, it can also lead to a lack of control over your portfolio. You can bring anxiety. Look, when you need to depend on someone else to tell you what to do, that's a recipe for having a shit ton of anxiety, frustration, just losing your mind with uncertainty with whatever the market does. So to offset these risks, it's crucial to invest time understanding the fundamentals and actively shaping your investment decisions. Now, tying this back to our contrarian investor perspective, it's about embracing your unique approach rather than blindly conforming to advice that might not resonate with your individual style. So don't just follow the crowd. Understand the fundamentals. Trust your instincts and make decisions that align with your financial journey. All right, y'all, this video is getting way too long, so hit that subscribe button and stay tuned next week for the remaining 4 principles.